Investing is one of the best ways to grow wealth. So why am I losing so much money? I've read blogs, I've watched YouTubes, I'm doing everything that the professional investors are doing. So why is it that I'm not having the same success that they're having? Why are they rich and I'm losing money? This makes zero sense. So I know that is some of the reactions that you probably have when you start investing or when you try a new strategy or something like that. And I can tell you, there's actually a lot of reasons that you have these problems and you just may not know it. And many times we want to say, oh, it's because of the economy, oh, it's because of the government or whatever. But really, all these rookie mistakes that you could be doing, you may not even know you're doing them, is holding you back from your full potential. So today, what I'm gonna do is I'm gonna go over the top 5 mistakes that rookie investors make when they're starting their investment career or starting new strategies that could be holding you back from being rich. All right, let's go. Before we start, let me tell you, we all make mistakes. Sometimes we even continue to make the same known mistake. And after we do it, we're like, why did I do that? And then you do it again. Come on, you know better. And so you'll probably end up making a list of these are things to not do. Just follow these steps to not make these same mistakes. I call mine my investment rules to make sure that I make the best, smartest decisions when investing in the market. Until you get to that point, let's go over the top 5 mistakes that new investors make when investing in the markets. And let's start off with number 1, investing in unknown markets. And this is a mistake that I see so many times, and it's a huge mistake. It's all those investors that want to make it rich as fast as possible, and they make dumb decisions that lead you into markets that you don't know anything about, and you hope that you're gonna accidentally get into the right one and strike it rich. Many times this happens with pharmaceuticals. Take Pfizer for example. You may know Pfizer for the vaccine, and maybe Viagra as well. But what else do you know about them? Who are their competitors other than the other vaccine makers? What are they in other than those 2 things? Okay, maybe Pfizer is a bad example because you've heard of Pfizer, it's a reputable company, but there's a whole bunch of other pharmaceutical companies out there that are going for 10 cents a share and oh man, this could be the next Pfizer. And I would say majority of those stocks end up dying, and then you got a Wolf of Wall Street penny stock situation. And then there are the hype stocks, the social media hype stocks like GameStop or AMC. This happened to the Bitcoin investors in 2018 when the Bitcoin was climbing so fast and all of a sudden it crashed to 50% levels. But really, how did these people find out about Bitcoin? Did they know anything about cryptocurrency or what Bitcoin was and what they're investing in? No, they're hearing from their friend that, yep, I invested $10,000 in Bitcoin and now I'm a millionaire. That's what they're hearing. So they're like, oh, I want to get a piece of that. But what happened is a lot of these people that jumped in when they heard all the good news about Bitcoin, they ended up investing at the peak, and then it crashed at 50% levels, and they lost half their money. And then they probably got out because they were watching all their savings just go down the drain, and they didn't think about maybe dollar cost averaging. But usually if you're going to invest in hype stock, that's not your first thought. And this leads us to our second mistake that rookies make when investing in the market is they sell during the dips. Like I said, instead of selling the dips, if they would have used dollar cost averaging and actually bought more Bitcoin during that dip, they'd be sitting pretty right about now. And many people know that the stock market is pretty cyclical in an upward direction, and it kind of bounces between a resistance line and a support line, which you would see in my candlestick video. But sometimes the market will break that support line and really create a downward trend. And this is where you need to channel your inner Warren Buffett and buy when people are fearful. When the market is going down, if you were to buy more with good companies, with good research, then you could probably ride it back up and make even more money. And for those who don't know, Warren Buffett had said, attempt to be fearful when others are greedy and be greedy when others are fearful. So the market dips are what I call buying season. New investors, when they see this dip, they're thinking, oh crap, I need to sell. I need to stop the bleeding. And then what they'll do is they'll see the market starting to climb back up, but they're kind of fearful, and then they'll buy back into that same stock they just sold for higher than they sold it for. So this is kind of the opposite of what you should be doing, right? It's not sell low and buy high. I'm pretty sure it's the other way around. All right, now the number 3 biggest mistake that new investors make when entering the market is they try to be a day trader from day one. And day trading seems so fun, exciting, just, oh yeah, day one. Like, you want to get in the market, you want to be that guy that's analyzing the numbers, buy low, sell high, woo, we're making money. Maybe you've done all these research into how candlesticks work and different strategies that professional investors use, and you think you have what it takes to get in there and make as much money as you can day after day. Unfortunately, there are a lot of things like regulations that are kind of holding you back. All right, first of all, day trade rules only allow you to make 3 day trades in a 5-day period, unless of course you have $25,000 or more in your investing account. But like most of us that have under $25,000 in their account, you can't do a day trade very often. So if you do Monday, you do 3 day trades, then you gotta wait till next Monday to do 3 day trades again. It's not really a lucrative process like that. And also, one of the things you really don't think about when doing investing is the taxes. So if you were gonna do day trading and you are selling stocks every day, then you're gonna have to pay short-term gains, which is higher than long-term gains on the profits that you make. And aside from that, the commissions and the bid-ask spread alone may only net you like pennies on the dollar for each trade that you do. I mean, yes, you made 1% for your day trade, but you only spent $50, so really you didn't make that much money. And trust me, day trading is much more of a headache than it's really worth. So I really do not advise it for new investors. Because there's one thing I've learned is that the market does what it wants. You can do all the research you want, and if you're anticipating it's about to go up and then it drops and you're like, what's going on? Well, you know what, the market does what it wants. So if you can risk it, then awesome. But really, for new investors, don't risk it. All right, and that brings us to mistake number 4. New investors, when getting in the market, that do not have any diversification. All right, I know we've all heard the old phrase, don't put all your eggs in one basket. Well, the thing is, that's very true for investing as well. Diversification is incredibly important. And starting out, you may not have that much money to invest. So really just getting some investments going in 1 or 2 stocks is completely fine. But as you're building your portfolio, you want to be able to invest in different areas of the market in case one sector drops a little bit, the other sectors can kind of carry it up, and then vice versa. Imagine if you put all your money in Blockbuster hoping that it's going to overpower Netflix since it's a big conglomerate. I mean, that would suck. And the thing is, you can start diversifying from day one, and the way you do this is through ETFs like SPY or QQQ, or SPY or the Qs, whatever you want to call them. And these are the ETFs for the S&P 500, SPY, or the NASDAQ, the Qs. So you can follow that trend, and you're pretty much getting a little piece of the 500 companies in the S&P 500. And even better, with Robinhood's fractional shares, you can buy just a piece of it, just how much money you can afford to have that full diversification of these ETFs. All right, the last mistake, number 5, that new investors make is that they completely ignore the numbers. So many new investors get FOMO, fear of missing out. And so they'll completely ignore the numbers and work on emotions because they think that I don't want to miss out on the next, Bitcoin. I need to hop in this. I mean, how many times have you thought, man, if I would have invested in Netflix back in the day, or that company, Amazon, if I would have got it at $19 a share, man, I'd be so rich. I mean, for me personally, I had the opportunity to buy Tesla in its infancy at $100 a share. But at that point, it was already double of what it came into the market at. It came in at $50, it was up to $100. I'm like, well, I missed it. I mean, it's doubled. It's not going any higher than that, right? But anyway, you've probably heard the whole GameStop's going to the moon, and GameStop went from like $4 a share up to, I don't know, $100 and something. And there's so many people that missed out, like, oh man, what if I had gotten it before the boom? But the problem with this is that if you were investing in GameStop, you completely ignored the numbers. The earnings per share for the company have been negative for so long, which with a lot of newer companies, it doesn't matter. Like negative earnings per share, you're fine, you're good. Like that's what it naturally does. But if the company's been around for a long time, like GameStop has, you really don't want to see a negative earnings per share. They're not making any money. And this is why investing long-term in some of these social media hype stocks is not good, because these investors are working completely on emotion, and they're completely ignoring all the science and facts and the numbers that are going behind making the company as valuable as it is. And eventually, it's gonna crash, leaving all these investors with nothing. And then what's gonna happen even more if you're working on emotions. So you say you bought the stock with your emotions and you're like, I'm gonna ride it for the long haul. But then it starts crashing because the numbers are actually catching up to it. What are these investors gonna do? Are they going to be smart, cut their losses because the numbers don't make sense? You don't dollar cost average if the numbers don't make sense. Or are you gonna ride it to the ground and be like, oh no, it's gonna go back up. I believe in it. I'm gonna stick with it. Well, that's not good. So when you're looking at these mistakes, just be smart. It's really not hard to look up a whole bunch of videos and articles on what some of the investors do that really drove their profits down. But these are the top 5 that I've personally seen, and many other people have seen too, that could really help you build your wealth by not doing these mistakes. This is not at all a comprehensive list. I have made so many errors when it comes to investing, and I really hope I will never replicate those errors. And if I can do anything, I hope that I can help you not have those same errors. I am always looking for the next strategy that's gonna help me improve my investing game. And I get anxious and nervous about it, and I end up making rookie mistakes. So that's why I have that list of rules when I'm investing to make sure I don't fall to those same emotional mistakes that I make as a rookie. I hope since you're watching this, you are trying to learn from the mistakes of others to not let history repeat itself. So I wish you all the best in your investing, and please don't forget to like and subscribe, and I'll see you next time. Later. I said, and that's a wrap, everybody.